VIP John AG here. Silver just lost $10 in 4 hours. $10. That's not a correction. That's not profit taking. That's a 30% collapse from the highs we saw just days ago, and it happened so fast that most retail traders didn't even have time to blink before their positions got liquidated. We went from $34.50 to sub-30 territory in a single trading session. Billions of dollars in open interest vaporized. Margin calls triggered across every major platform. And while the mainstream financial media is calling this a healthy pullback, I'm about to show you the documented evidence that suggests this was anything but organic. What happened in the silver market this week will be studied for years. And whether this is the final crash or the setup of a lifetime depends entirely on whether you understand what actually just occurred. Let me walk you through exactly what happened with the precision this situation demands. On May 21st, silver reached an intraday high of $34.59 on the COMEX. This was the highest level we had seen since 2012. The momentum was undeniable. Retail interest was surging. Social media was exploding with silver content. And then within hours, everything reversed. By the end of that session, silver had dropped to approximately $32. The next day, the selling intensified, and by the time the dust settled, we were looking at silver trading around $30.50, with some contracts dipping below that psychological level during the most volatile moments. Now here's where it gets interesting. This wasn't a gradual decline. This was a coordinated waterfall. The selling pressure came in waves, with massive blocks of paper contracts hitting the market during low liquidity windows. We saw over 200 million ounces worth of paper silver dumped in less than 90 minutes during the initial drop. Let me say that again. 200 million ounces in 90 minutes. Global annual silver mining production is approximately 830 million ounces. So in an hour and a half, someone sold the paper equivalent of roughly 24% of annual global mining supply. This is not speculation. This is documented trading data. Gold experienced a parallel correction, dropping from its recent highs above $3,500 to approximately $3,290. The gold-silver ratio, which had compressed to around 97-1 during silver's rally, expanded again as silver underperformed gold during the sell-off. This ratio behavior tells us something important. When silver falls faster than gold during a correction, it typically indicates paper market manipulation rather than genuine physical selling. Physical sellers don't dump that aggressively. Only institutions with unlimited paper supply can execute that kind of coordinated attack. The COMEX registered inventory situation adds another layer to this story. As of the most recent data, registered silver inventories stand at approximately 289 million ounces. This is the silver that is actually available for delivery against futures contracts. Eligible inventory, which is silver stored in COMEX vaults but not registered for delivery, sits around an additional 92 million ounces. Combined, we're looking at roughly 381 million ounces total in COMEX warehouses. Now compare that to the paper contracts traded during this sell-off. The open interest in silver futures represented well over 1 billion ounces of notional silver. The paper-to-physical ratio on the COMEX has become so extreme that the price discovery mechanism has completely decoupled from physical reality. The Shanghai Futures Exchange tells a completely different story, and this contrast is critical for understanding what actually happened. While COMEX was experiencing this paper avalanche, Shanghai silver premiums remained elevated. The Shanghai premium over COMEX has been running between 5 and 8% consistently, with spikes to 10% during periods of high demand. This premium represents the real cost of acquiring physical silver in the world's largest silver-consuming nation. If this were genuine selling pressure from physical holders, we would see Shanghai prices collapse in tandem with COMEX. Instead, we see Shanghai holding firm while COMEX gets hammered. This divergence is the fingerprint of paper manipulation. But here's the thing. The macroeconomic backdrop that drove silver to those highs hasn't changed. The Federal Reserve is still navigating an impossible situation. Interest rates remain elevated, yet the economy is showing signs of strain. The most recent inflation data showed persistent price pressures in core categories. The Fed funds rate sits between 5.25% and 5.5%, And futures markets are still debating whether we'll see cuts in 2025 or whether rates stay higher for longer. This uncertainty typically supports precious metals because it undermines confidence in the dollar system. The dollar index has been volatile, trading in the 103 to 105 range, unable to establish a clear trend. The geopolitical landscape remains extraordinarily supportive for precious metals. The situation between Russia and Ukraine continues with no resolution in sight. Tensions in the Middle East persist. The BRICS nations continue their de-dollarization efforts, with multiple central banks adding gold to their reserves at the fastest pace in decades. China's central bank has been buying gold for 18 consecutive months. Russia, India, Turkey, and Poland have all been significant buyers. This central bank demand represents a structural shift away from dollar-denominated assets that isn't going to reverse because of one volatile week in the futures market. Looking at the numbers, about 75% of you watching aren't subscribed. If this unfiltered analysis is cutting through the noise and giving you clarity, hit subscribe. That's how we grow a community built on truth, not hype. Drop VIP John AG in the comments so I know you're part of the team. If it's not for you, no hard feelings. I don't chase empty metrics. I don't sell signals. I don't offer mentorships or courses. What I do is present the data and let you make your own informed decisions. This channel exists because the mainstream financial media refuses to cover what's really happening in these markets. Now let's continue. Here's what makes this truly insane, and this is the part they don't want you to see. The timing of this sell-off coincided precisely with several factors that, when connected, reveal a pattern too consistent to be coincidental. First, the COMEX announced margin hikes on silver futures just as prices were accelerating higher. Initial margin requirements increased by approximately 15%, forcing leveraged traders to either add capital or reduce positions. This is a tool that has been used repeatedly throughout history to cool precious metals rallies. They did it in 2011, they did it in 2020, and they did it again this week. Second, and this is the smoking gun, the Bank for International Settlements released data showing a massive increase in short positions held by commercial banks in the weeks leading up to this sell-off. We're talking about concentrated short positions representing hundreds of millions of ounces. These aren't hedge positions. The scale is too large. These are directional bets against silver made by institutions that have a documented history of suppressing precious metals prices. CNBC won't tell you this. Bloomberg won't cover it. But the data is publicly available if you know where to look. Third, the sell-off occurred during a period of thin liquidity, specifically during the Asian trading session crossover, when both London and New York markets had reduced participation. This is the classic playbook. You wait for a moment when there are fewer buyers in the market. You dump a massive amount of paper supply. You trigger stop losses and margin calls, and you create a cascading effect that amplifies the initial selling pressure. The victims are retail traders and small speculators. The beneficiaries are the institutions who accumulate physical metal at artificially suppressed prices. The connection between these events is not speculation. It's documented. It's patterned. And it's been repeated so many times that anyone paying attention can see it coming. As I said in the previous video, when silver approaches certain price thresholds, the paper market intervention becomes almost predictable. $32 was a key resistance level. Breaking through it with momentum would have triggered a massive short squeeze, and certain institutions simply could not allow that to happen. Now let me be crystal clear about the physical versus paper divergence because this is where the real opportunity lies for those who understand it. While paper silver was collapsing, physical silver dealers were experiencing the exact opposite. Premiums on physical silver products expanded significantly during the sell-off. American Silver Eagles, which normally carry premiums of $5 to $7 over spot, saw premiums spike to $8, $9, even $10 in some cases. Generic silver rounds and bars saw premiums increase from $2 to $3 or $4 over spot. This is counterintuitive if you believe the mainstream narrative. If there's genuine selling pressure, physical premiums should compress, not expand. Dealer inventory levels remain constrained. Several major online dealers reported sold-out conditions on popular products within hours of the price drop. Wait times for certain products extended from days to weeks. This is the reality of the physical market. People were buying the dip aggressively, snapping up every available ounce at these lower prices. The sovereign mints continue to report robust demand. The Perth Mint, the Royal Canadian Mint, and the United States Mint all have production schedules that extend months into the future. Backlog conditions persist across the industry. Shanghai delivery data reinforces this narrative. Physical withdrawals from the Shanghai Gold Exchange have remained elevated. Industrial users in China are securing physical metal regardless of what the paper price does. They understand that paper prices can be manipulated temporarily, but physical supply is finite. The solar panel industry alone is consuming over 150 million ounces of silver annually, and that demand is growing at double-digit rates. Electric vehicle production requires silver. Artificial intelligence infrastructure requires silver for its thermal and electrical conductivity. Defense applications require silver. This industrial demand is non-negotiable. It doesn't care about futures market manipulation. Let me address the bearish case head-on because balance matters. If you're going to make informed decisions, you need to understand the legitimate risks on the table. The margin hikes I mentioned earlier could trigger additional forced liquidation if prices don't stabilize quickly. Leveraged traders who survive the initial drop might face additional margin calls if we see another leg down. The technical damage from this sell-off is significant. We broke below several key moving averages and support levels. Momentum traders who use technical analysis are now looking at bearish chart patterns, and their selling could create additional pressure. The broader market environment presents risks as well. If the Federal Reserve maintains its higher for longer stance and the dollar strengthens from current levels, that creates headwinds for all commodities priced in dollars. A genuine recession scenario, as opposed to the soft landing narrative, could temporarily suppress industrial demand for silver. Jewelry demand is price-sensitive and could decline if economic conditions deteriorate. The mining industry, while facing supply constraints, could potentially increase output if prices remain elevated long enough to justify capital expenditure on new projects. There's also the risk of additional intervention. If the powers that be are determined to suppress silver prices, they have demonstrated repeatedly that they have the tools and the willingness to do so. Regulatory changes, additional margin requirements, position limit adjustments, and coordinated selling can all be deployed. Anyone who tells you that silver is a guaranteed winner doesn't understand these markets. This is why I always emphasize position sizing, diversification, and never investing more than you can afford to lose. Now here's the bullish case, and despite everything I just said, the fundamentals have not changed. They've actually strengthened. The supply-demand dynamics for silver are the most favorable they've been in decades. The Silver Institute projects a structural deficit for the fourth consecutive year. Annual demand exceeds annual supply by approximately 200 million ounces. This deficit is being met by drawing down above-ground inventories that took decades to accumulate. That's not sustainable indefinitely. J.P. Morgan's position in physical silver is well documented. They accumulated over 1 billion ounces during the years when prices were suppressed in the teens and 20s. They didn't accumulate that position to lose money. The same institutions that manipulate prices down are simultaneously positioning for prices to go up. This tells you everything you need to know about their long-term expectations. When the smart money is accumulating physical while using paper to suppress price, you're being given an opportunity, not a warning. Central bank gold buying continues to accelerate. While central banks don't typically hold silver reserves, their pivot away from dollar-denominated assets reflects a broader loss of confidence in fiat currencies. This sentiment inevitably spills over into silver markets. The monetary metal and the industrial metal are connected. When gold breaks to new highs, silver eventually follows, typically with greater percentage gains due to its smaller market size. The mining supply situation remains constrained. Primary silver mines are increasingly rare. Most silver production comes as a byproduct of copper, zinc, and lead mining. This means silver supply doesn't respond quickly to price increases. Even if prices doubled tomorrow, it would take 5 to 7 years for significant new supply to come online. Meanwhile, demand from solar, electronics, EVs, and emerging technologies continues to grow annually. The setup we're looking at right now, sub-$31 silver after a $10 correction, represents exactly the kind of opportunity that creates generational wealth for those with the conviction to act. If you've been watching this channel, you already knew this correction was coming. We discussed overbought conditions. We discussed the resistance at $32. We discussed the historical patterns of intervention at key price levels. None of this should be surprising. 3 key takeaways, and we're out. 1. The $10 drop in silver was not organic price discovery. The volume, timing, and coordination point clearly to paper market manipulation designed to trigger stops and margin calls. The smoking gun is the concentrated short positions combined with margin hikes and thin liquidity attacks. 2. Physical market behavior directly contradicts paper market action. Premiums expanded, dealer inventory tightened, and Shanghai continued to show robust demand. This divergence confirms that paper prices do not reflect physical reality. 3. The fundamental thesis for silver remains intact and has actually strengthened. Supply deficits continue, industrial demand accelerates, and central banks globally are pivoting away from dollar assets. Short-term paper manipulation does not change long-term supply-demand dynamics. The unresolved tension is this: at what point does the paper market lose its ability to dictate prices? With COMEX inventories declining, Shanghai demand persistent, and the paper-to-physical ratio at absurd levels, we're approaching a breaking point, but we've been approaching that breaking point for years. The question isn't if paper loses control, it's when, and whether you're positioned correctly when it happens. Do your own due diligence. Understand the risks. Be accountable for your own decisions. This is not financial advice. I'm simply presenting data and analysis for educational purposes. Protect your capital. Don't over-leverage. And understand that volatility is the price of admission in these markets. Invest with logic, not hype. VIP out.